Thanks, Jerry. Good afternoon. Thank you all for coming to this last session. I wasn't sure how many people would turn out, but looks like we've got a decent showing. 4 years ago, my very first day at Strike was spent travelling here to Perth for the Good Oil Conference. Within the first hour on the ground, we started talking about what we were doing with a new project. Strike had just had some success with a couple of wells that were operated by Beach Energy in a couple of our non-operated permits, Pearl 94 and 95, Davenport 1 and Marsden 1. We had some really exciting prospects there for our project in the Pearl 96 in the Weena Trough. At that time, everyone was riding high on the high oil price. No one was talking about shortfalls of gas on the east coast of Australia. And the project that we were talking about in the Southern Cooper Basin was interesting, but there was a long way to go. So 4 years' time, we've done a lot. Preparing for the presentation actually gave me probably the first time to really reflect on just how much we've done over that 4 years. And it's been a fantastic and exciting process to be part of. The excitement's not done yet, and we're quite confident about that. So, for those of you who would like to have seen a disclaimer, you'll be happy to know that it is at the back of the presentation. Please make sure you take the time to read that. We'll get into talking about Strike. Strike's been around since 1996, founded by Simon Ashton, one of our long-time directors who's here today. We've got a market cap of about $90 million, just over, at the moment. Financial year end, we had about $7 million in the bank. Subsequent to that, we also had an R&D return. We've got about 2.3 million net acres under permit or application in the southern part of the Cooper Basin. A huge resource. We've got a fantastic team that's we've built up over this last 4 years to work that. Depending on just how active we are, that's anywhere up to 25 to 30 people. That includes our team actually out in the field doing the testing operations. So obviously we've heard a lot over the last couple of days, yesterday and today, about the East Australia gas market. I'll try not to bore you too much about that because you've already been bludgeoned to death with the story of the East Australian gas market, but it is a really key part of the story, and it's a key reason that we are so excited about the project that we've got here. We've made really solid operational progress towards trying to commercialise this huge prospective resource, and we've got significant opportunity here for value creation for our shareholders. So the East Australian gas market, we're all fairly familiar with this. I think historically, the last 40 odd years, the East Australian gas market has been well served by Gippsland, Cooper Basin. We've had low gas prices for a long, long time. All of that cheap gas is pretty much gone. Obviously over the last 20 years, the coal seam gas industry in Queensland has gradually proven up what's proven to be a massive, massive resource. So much so that they had to make their own market for it, and so we have our competing LNG projects in Queensland. Obviously they got a little bit carried away perhaps, and more recently we've started to hear stories about maybe there's a bit of a shortfall in gas with that huge demand that's come in, and of course the continuing domestic gas requirements. So looking forward over the next 20 years, everything we're seeing, we're reading, same as everyone else, is showing somewhere around 40 TCF of demand over that period of time. Room enough for quite a few projects to get up on the east coast of Australia, and I think as an industry we need several projects to get up, and I certainly hope that we're one of those projects, and we're doing absolutely everything we can to make that the case. So as I said, six trains, 6 LNG trains, obviously demand through the roof. We won't dwell on this too long. Supply, quietly over the last little while, we've had about 3 TCF of write-offs in the East Australia gas market. That's really what's leading to the significant shortfall that is being forecast. We need new supply, as I said, I think from more than one party, given the timeline, or we're going to see demand destruction, whether that's through LNG backing off or whether that's through the domestic market. So where we see that most crystal clear for Strike, we're looking at the Adelaide STTM gas prices. Now the spikes are exciting and people have been talking about the spikes, but the key thing is over a 3-month period there from June to August, the average gas price this year was over $10. 12 months prior, it was under $5. So that really highlights what's going on in the gas markets, and it's something that we at Strike have seen as a potential outcome for a number of years. It's why we started to seek out industry partners in our projects. Thankfully, some of those customers also saw that they were in a position and needed to do something to try and help bring more supply to market. So Orica, Aurora, Austral Bricks or Brickworks, Adelaide Brighton have all been very supportive and have put about $17 million over the last couple of years into Strike, with the promise of more if we're able to take this all the way into development and commercialise. More recently, obviously the industry response hasn't been quite quick enough for government, and we've seen in South Australia there just last week an announcement around an initiative to provide $24 million to upstream proponents to provide more gas into the South Australian market. It just highlights how desperate that situation is. I'll just move on from the summary here. I'm sure you'll all be keen to read that later, but 40 TCF of demand, supply tightness, and everyone, industry and government in South Australia actually doing something to try and move things forward. So I'll try and talk a bit more about the Southern Cooper Basin Gas Project. What we've got at the moment is a fairly modest or moderate size contingent resource that we booked around April of last year. It was based off of just a couple of zones in 2 individual wells. It's a little bit smaller than the contingent resource that Cooper Energy it looks like that they're about to actually commercialise. But there's a huge prospective resource. Now, we'll see through the fullness of time just how much of that we are or are not able to commercialise. But the prospective resource, even in the mid case, if we're able to make that work, that puts us into that large resource category. Now, I'm not saying that right now that we've got another GLNG project to go, and I certainly wouldn't want to be doing that. We don't see ourselves at Strike as being proponents of another LNG project, but we do see ourselves as being sellers of gas potentially into that in that upside case. So the project is really ideally located to get development moving very quickly. When I first talked to Strike and came on board, what really excited me, it was a potentially tricky project at that time. We really didn't know a lot technically, but if we could make it work technically, it was right on the pipeline. So it means that we're not needing to spend $100 or $200 million on a pipeline just to tie into the market. We literally, our current test location is 4 kilometres from the Moomba Adelaide gas pipeline. So what we're doing is targeting near-term domestic market and tying into that Moomba Adelaide pipeline as soon as we're able to confirm commerciality. We've been working solidly in the background on a demonstration gas processing plant concept, which has thrown up some really quite innovative solutions that are surprisingly cheap, and maybe not surprising given the rest of the industry at the moment, but also with surprisingly short timelines. So that really fits with what we're actually trying to do, and with the kind of timelines that we tend to move in, which are fairly short. Longer term, as I mentioned before, we see ourselves as potentially feeding into that LNG export market and selling to some of those project proponents. So this is the last nearly 3 years of work, which has been at a really very rapid pace. In PEL 96, the Southern Cooper Basin Gas Project, we've spent close to $80 million. That's about $51 million strike share. Of that, our gas offtake customers have provided $17 million in capital. We've managed to recycle as much capital as possible, and we've gotten $23 million out of the R&D from the Commonwealth. And strike shareholders have put in about $11 million into the project. As I said, we've been particularly active. Our first well, Le Chiffre 1, Kleb 1, first wells that had been drilled into the Weena Trough, into the deepest part of the Weena Trough. It was completely new. We saw some quite exciting things. Le Chiffre 1, we were very excited that we ended up with over 100 metres of net coal, with an individual seam that was about 30 odd metres thick. At Kleb 1 we saw even more. It was about 145 metres of net coal. It was a pretty exciting time. We then moved through 2014 with the fracture stimulation and completion program, and then commenced our testing program. We started to see early sustained gas flows at fairly modest rates, and with time we have seen those building up. Those gas flows what have allowed us to book that initial 2C resource that I mentioned earlier. Dugula McNaughton are the company that certified that 2C resource. And we've continued on with our fracture stimulation program then of Kleb 2 and 3, and a conversion of our Kleb 1 well from jet pump to beam pump. This year has perhaps been even busier than the last couple. We drilled Kleb 4 at the start of the year. We started to see a bit more gas coming out of Kleb 2 and Kleb 3, starting from kind of October last year, then December, then February, and all that really did was highlight that whilst the jet pumps are fantastic for dewatering, they're not so fantastic when you start to get a transition to gas. And so we needed to try and make a step change in how we were going to approach the project. So Kleb 4, we fracture stimulated that in June and installed our first ESP in July. That's all going quite well at the moment, but it's really still too early to call in terms of technology. We did a major facility upgrade in around March of this year as well, increasing our pumping capacity for the jet pump wells, and I'll talk about that in just a couple of minutes here. So, in terms of what do we know, we've been de-risking this project. We know we've got a huge amount of net coal. We've got gas. We've got a much better handle on the range of saturation than we did previously. We've got good deliverability with our new setup on Kleb 3. Last month we were up close to 1,000 barrels a day of water from Kleb 3. Again, just highlighting the effectiveness of, or the efficiency of the jet pumps with dewatering efforts. And we're starting to see we are seeing larger volumes, drainage areas from the wells, which is a really good story in terms of ultimate recoveries and getting a good handle on our well spacings. So the real key to this project is pumping, and it shouldn't be a surprise to anyone who's had any experience with coal seam gas. It's all about pumping. Now, we are deeper than all the other projects up in Queensland. We do have a surprising amount of natural permeability, at least an order of magnitude higher than I had originally thought we would have before we came into the project. But it's really all about pumping. So stimulations, and what we've learned is that bigger is better, but there is a limit, and beyond a certain point, it's not really, there's not much to be gained. And then it's artificial lift and pumping out. So we've been testing 3 different types of pumps, and really this is the R&D work. This is what's helped to pay for a lot of the testing. That $23 million in R&D refund, it's because we are trying to solve a different problem here. PCP pumps, which are quite commonly used in coal seam gas in Queensland, simply won't work. One of the reasons we went with jet pumps originally was for the level of flexibility that they would provide. So they have absolutely provided that flexibility. We have started to see gas from those wells, and we've started to see the ramp up. We've made some changes more recently to be able to extend that and be able to handle yet more gas through the jet pumps, but we're really focused on keeping those wells as dewatering wells, keeping the water away from Cleb 1 with the beam pump and the open annulus, and Cleb 4 with the ESP. And those wells are set up as gas producers. So if we talk a little bit about what we're seeing there, and that interference effect is what's going to help us drive towards a result and commercial gas flows. So we talked about the 2C resource before. Our contingencies were, number 1, commercial gas flow rate. Number 2, a better understanding of the drainage areas and the types of volumes which would need to be removed. And the third one was drilling some additional wells and showing that we had something beyond just those single wells that we had previously drilled. So where we are at the moment, Cleb 2 and 3, we're seeing the largest volumes. Those 2 wells, unsurprisingly, have produced the largest volume. Every time we have any kind of extended shut-in, we start to see more water come in, but whilst we're producing, we see quite effective pressure drop in the reservoir. We've got good data collection with bottom hole pressure gauges there, and we're starting to see, we get the pressure down and we start to see the gas come, which is exactly as we would expect. With Cleb 1 and Cleb 4, we're just holding those fluid levels as low as we can, and we're really focusing just on reliable, stable pumping operations. The bulk of our capital for this current phase is capital work is finished, and what we're really focused on is just stable testing, reliable testing. So what we've learned here is that the dewatering task is finite. When we drilled Cleb 4, we got our initial pressure before we fracture stimulated, and we saw that we were 200 to 300 psi below the original pressure in the other Cleb wells. Similarly at Le Chiffre 1, which had produced for about 9 months from 2 zones. After 14 months of shut-in, we were still about 200 psi below the original pressure. So we know that task is finite, and we are absolutely making good, solid progress. The interference effect, as I said, that's what will get us there. We had fairly recently Cleb 1, Cleb 4 over a period of time, both of which were pumping stably. We saw the fluid levels coming down, the reservoir pressures coming down. We shut in Cleb 3 for some routine maintenance. It was shut in for about 12 hours, as it turned out, and the next morning when we got ready to bring that well back on, we saw that the fluid level in both wells had come up. So it just shows just how effective that has been. So the deliverability of the reservoir is good. We're understanding more and more about that every day. We're very excited about where we're heading. And I think for investors that have stuck with us over the last couple of years, I know that everyone would like to see results sooner and faster, and so would we. We have learned a lot over that last 3-4 years of activity, and we're confident that we will achieve a result, and that is not too far away. So just in summary, obviously the tightening gas market in East Australia is one of the keys to this story and what makes it so exciting. We've made a huge amount of progress in a very short period of time, and with very little shareholders' actual funds. We do have potential for huge value creation if and when we're able to prove the concept of the Southern Cooper Basin gas project. Now, for those of you who were disappointed about not having that notice up front, I did promise that it would be there at the end, and sure enough, here it is. Please take time to read it at your leisure later on. Thank you very much.